Hello, everybody. Professor Barth here, Associate Professor of History at Arizona State University. Welcome to Inflation Nation November update. Obviously, everyone is thinking and talking about the midterms right now. Not going to comment on that in this video other than to say I'm in Maricopa County, Arizona. I ran into just enormous problems voting on Tuesday. I voted in person. And my voting site, there was a 2-hour long wait because the tabulators were busted. I actually initially went at 6:45 in the morning. I left because I assumed the tabulators would be fixed later in the morning. Came back at 10 o'clock in the morning, still busted, still a 2-hour wait. Then I drove 20 minutes away to a different site and things were working all right there. But the fact that it is 2 days out from election day and you still have over 500,000 votes that still haven't been counted in Maricopa County, a third of the vote total has not been counted. It's just a total embarrassment for Arizona. Arizona is a laughingstock at this present moment, and it's a shame because it's a great state, and it's something's got to be done about our elections. It's just a total mess. When I was growing up, you knew the results election night. Now it's 2 days later, and still 500,000 votes haven't been counted. So it's just absolutely unacceptable. It cannot be done. You look at states like Florida and they have like 95% of the votes counted on election night. Arizona, big blot on our state, but hopefully that gets fixed. All right, so the numbers, the latest inflation numbers for October, of course, we get the October numbers, the Consumer Price Index, CPI from the Bureau of Labor Statistics. We get those numbers in early November. And 7.7% year over year inflation. The estimate was 8%. And so there's some positive spin on these numbers this morning. And there are some reasons to be a little hopeful here. We'll take a look at the exact numbers, but let's remind ourselves 7.7%. The target inflation rate for the Federal Reserve is 2%, which I'm still not persuaded. I've never been persuaded that even 2% is a decent target. But even if you were to accept that 2% target rate, 7.7% is extraordinarily high. But there is some reason to believe perhaps prices may begin to fall. We'll take a look at those in a second. But 7.7% year over year CPI. Inflation remains a stubborn and persistent problem. And in fact, the CPI year over year has exceeded 7% for the last 10 or 11 months. So for the last 10 or 11 months, I'm not going to calculate it here in real time, but it's been just shy of a year that we've had year-over-year inflation above 7%. That is unacceptable. And you look at it, and there is this drop from June, but by any other metric, this is extremely high inflation, and it's hurting working families. I've discussed this a lot in our series. Core remains really high. Core CPI is CPI minus food and energy, which tend to be more volatile sectors. And here, there's not much of a decline at all, really. I mean, in fact, actually, core CPI year over year is a bit higher in October than it was earlier in the summer. If you compare core CPI with overall CPI, you have that dip in overall CPI, but core remains stubbornly high. The month-over-month figures are useful because you're able to zoom in on what's happening in on that month-to-month level. And here we're at 0.4% increase in the CPI in October over the month, but there's not a whole lot of reason to be optimistic just from that figure. And in fact, actually, I mean, it was 0% in July, 0.1% in August. A lot of that had to do with gas prices. And so 0.4%, yeah, that's lower than it was earlier in 2022, but it was 0.3 in April, and then look what happened. Core CPI, same story. Core CPI month over month rose by 0.3%. That's down from the September numbers, which was 0.6. But we've seen this before. And so the big question is, does this signal a more lasting decline in month over month core CPI? And I'm not yet persuaded. I'm open to it, but I'm not persuaded yet that this is that this monthly drop, month over month core CPI, means translate or leads one to conclude that oh right, now we're on sort of a lasting decline. I don't see that yet. So those are numbers. You're getting a lot of optimistic spin, predictably, from financial media. The stock market did well this morning. And so all eyes now are on the Fed. Now the FOMC is going to hold its next meeting, policy meeting, a month from now. I think it's December 13th, mid-December. Now, no, the last FOMC meeting, we had another increase in the federal funds rate by 75 basis points, or 0.75 of a percentage point. That was a fourth straight meeting that interest rates had risen by 75 basis points. And so we've seen quite an increase in 2022 from, and this is the upper limit. Remember, the Federal Reserve sets a target rate, and that target rate is within a quarter. And so, basically it started from 0, and now we're at 4%. 3 3/3 to 4% is the Fed's target range. But you look at it historically, and there's where we are. This is from the late 1960s. Volcker took it all the way up here. We're still just down here. And the question is this enough? My opinion is that it is not. It is not. The Fed's going to have to take it higher. I think most analysts would agree with that. If the Fed is going to get inflation under control, they're going to have to take rates significantly higher than 4%. But that's where we are right now. Now, Americans became, and stock jobbers on Wall Street became addicted to cheap money during this era. You got the Greenspan era, sort of the shift to Bernanke around here, and then all through the 2010s, beginning with Bernanke through Yellen, with a brief exception in the late 2010s. Cheap money. Americans became hooked, so that 4% seems high. It seems high, but historically it's not. It's not. Now, Powell gave a press conference on November 2nd of this year after the Fed announced another 75 basis point hike, and if you read the transcript, I got a few excerpts here. He said the Fed is, quote, strongly committed to bringing inflation back down to our 2% goal. How do you get to 2%? 2% is going to require a lot more rate hikes. Okay, it's gonna have to. It's hard to put an exact figure on it, but one would assume at least 7-8%. At least. Maybe higher, to bring it down to inflation down to 2%. But Powell seems to is communicating that the Fed wants to bring inflation down to this goal. Now, remember in 1977, I talked about this in my History of Money course. You can find the lectures online. In 1977, the Federal Reserve Act was amended to give the Fed a dual mandate, and that dual mandate is price stability, which the Fed defines as 2% inflation, and full employment, maximum employment. So, but the Fed's clearly failing on this account of price stability. So Powell here is signaling, no, the Fed's strongly committed to bring inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. He's right about that. And serves as a bedrock of our economy. He's right about that. Without price stability, the economy does not work for anyone. We continue to anticipate that ongoing increases will be appropriate. Restoring price stability will likely require maintaining a restrictive stance of policy for some time. So he's signaling here we can expect, obviously, further increases. Now, the question is, at the Fed's next policy meeting in December, are they going to go 75 basis points or will they go down to 50? I don't think we'll see a quarter. They could go down to 50, which would be a mistake, in my view. If I was on the FOMC, I would probably cause a little bit of trouble, but I would lobby pretty hard against that. He says at some point it will become appropriate to slow the pace of increases. Now, some people interpreted this statement as, signaling in December it won't be 75 basis points, it may be 50. At some point, it will become appropriate to slow the pace of increases as we approach a level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal. But you have to ask yourself, how do you bring inflation down to 2%? It's going to require interest rates a whole lot higher than 4%. So the Fed has a long way to go. They seem to be signaling that they're serious about bringing inflation down to 2%, even if it means a recession. He says we still have some ways to go. So there's really no telling how far will this go. And if inflation if the year-over-year CPI falls to, let's say, 6% in a few months, maybe let's say the March numbers or whatever of 2023, it's 6%. What does the Fed do? Does the Fed lower rates? Or does it increase it at like sort of a high rate? Maybe by March of 2023, the rate is 5.5%. Does the Fed lower rates? If year-over-year CPI by next spring is at 6%. It's going to be a difficult decision for the Fed because Powell makes it clear here that the goal is 2%. So a whole lot of questions loom for 2023. 2023 is going to be a big year, and that's why we shall continue these monthly reports to track what the Fed is doing. They're going to have to raise interest rates a whole lot more, and then they're going to have to resist the temptation if, it's a big if, the CPI year over year does fall to the 5-6% range by summer 2023. There's going to be a lot of pressure on the Fed to lower rates down to, a 2 or 3% level. If the Fed does that, they're going to repeat the mistakes of the 1970s. I have a whole video on 1970s monetary policy. I'll link to it at the end of this video on the end screen. If they respond to a slight decrease in the CPI by lowering rates, they risk having the inflation just shoot right back up again. That's what happened in the 1970s. In the early 70s, there was a lot of inflation. The Fed hiked rates, and then when inflation slowed a little bit, the Fed cut rates, and then inflation just popped right back up like a beach ball in the ocean. When you let go, inflation just popped right back up, and then you got Volcker. And then Volcker took rates up to 20%. So the 2023 is going to be a big year for the Fed and for monetary policy. We're going to track it here on this channel. But the Fed's obviously going to have to continue to raise rates. Now, for as far as the Fed's balance sheet goes, this is the Fed's balance sheet in 2022. Now, this is interesting. We have a decline here from the peak in late spring of this year, almost hit $9 trillion. It's gone down $300 billion since that point, owing to, among other things, QT, quantitative tightening. Got a whole video on that I recorded in February. But this, it looks like a meaningful and significant drop in Federal Reserve assets, and Powell even mentioned this in his latest press conference, but it's only a 3% drop. The Fed's balance sheet has only decreased by 3%. And if you zoom out, there's where we are. Okay. This is the Fed's balance sheet from 2018 to the present day. Okay, you got a little dip there. You can see this isn't a significant decline in the Fed's balance sheet. I mean, it more than doubled during COVID. And so the Fed's got a long way to go. Fed's got a long way to go. Now, what does this all mean for Americans? Now, obviously, we've talked a lot about inflation and what inflation does to the working class. Workers are disproportionately hurt by price increases because their wages never keep pace with price increases. And but it what does the spike in interest rates mean for ordinary people? And let me give you one just very practical example. What about mortgage rates? The 30-year fixed rate mortgage. Now here's a chart from the Federal Reserve itself of the average 30-year fixed rate mortgage in the United States. And you see here at the end of 2021, going into 2022, the average was around 3%, which is a low rate. And over the course of this calendar year, we're now up to, actually, this hasn't been updated. The latest numbers after the last FOMC meeting, the 30-year fixed rate average in the U.S., I believe, is 7.2%, so about 7.25%. That's a big jump from 3%. And then if you zoom out again, here's a chart of the 30-year fixed rate mortgage average since 1970. There's where we are. And you look at that and you're like, sheesh. Again, we were hooked on cheap money. The 2010s was the era of cheap money. And the chickens have come home to roost. Because if you look at it, I was born in 1984. My parents bought their first house in 1981. Might have been 82. And their 30-year rate was about 13-14%. And I remember when I was a kid always hearing my parents talk about refinancing and didn't know what the heck that meant. But you're looking at this graph, okay, I can see why they were refinancing their mortgage, because rates were going down pretty steadily. But they look at that, in the mid-'80s, they were above 12.5%. Then they went down. But even as late as 2000, mortgage rates were, well, where they are now, 7.5%. And then since 2000, it's just been low rates, which has contributed to this housing bubble, but it's also made houses a lot more affordable for people to buy, because, well, it's sort of it's difficult to analyze, because on the one hand, your interest rate in taking on a mortgage is a lot lower, but because there are so many buyers in the market, including not just single families, but also speculators, investors, because there's so many people in the housing market, housing prices have shot up. So you're paying a higher price for your house than you were before the year 2000, but with a lower rate. But anyway, this could go a lot higher. This 30-year fixed rate, and will go a lot higher. We may see 10% rates, which is what we had for much of our history, and that has real world implications. Let me give you an example. Say you have a $300,000 house. You and your wife decide to purchase this house, 10% down. You put 10% down in your house, and let's say you got this a year ago. You bought this home a year ago, and you locked in a 30-year rate at 3%. Your monthly payment on that house, your monthly mortgage payment, is $1,300. Okay, that's affordable. It's like rent. What happens when the mortgage, the rate jumps to the present moment? So right now it's 7.25. At 7.25, that same house, 10% down, that mortgage monthly payment will be $2,000. That's an extra $700 a month. That's a huge difference. Big difference. $700 a month. You times that by 12, and that's a lot of money that you're paying every year in interest. These are that differential is interest that you're paying. What happens if you take it to 12.5 and you say, "Oh, Barth, that couldn't happen. 12.5." Well, it happened here. It happened here. What happens if you take it at 12.5? That monthly payment is now $3,000. $3,000. Now, if the 30-year rates were to ever rise to that level, guess what's happened to housing prices? Housing prices are going to tank. Okay, the housing market's not going to do well in that. So there may be some sort of trade-off here where now that $300,000 house, you could buy it at $200,000, but your rate is going to be 12.5%. Okay, but nevertheless, you see what a difference these interest rates have on just ordinary Americans. Or take a look at credit card bills. Credit card, your adjustable rate, your APR is going up. So if you run a credit card debt, that's going to become costlier now for you to run. So that's what we're looking at. We're going to see higher rates. Zooming in on the prices, I'm not going to go through all these, but if you're interested in these, pause the screen and you could take a look at them. The key takeaway here, food at home year over year is up 12.5%. For the month of October, it went up 0.5%. 0.5%. All these numbers, you can download a PDF from the Bureau of Labor Statistics and take a look at each and every category. If you look at food prices month over month, food total, which includes not just grocery prices, food at home is basically your grocery bill, but also food away from home, which is like Taco Bell or your restaurant or whatever. Here's food prices month over month. And so this is I said at the beginning, there was some slightly optimistic news. For the third straight month, food prices month over month are down, or the increase, food prices haven't gone down, but they've risen every month, but the rate of increase is less, it's smaller. So that's good news. It seems to be a fairly consistent trend, which is positive. Would like to see that to continue. Okay, but still, that's a high number month over month. It's going to have to be brought down even further. And you look at late 2021 and similar increase in food prices month over month, and look what happened, just shot back up again. So be a bit tepid in our optimism here. Energy prices, gas prices went up 3% in the month of October. Energy total went up 1% for the month, 17.5% year over year. And you take the same look here, energy prices, quite a volatile sector. And so for the month of October went up a percentage point. That was actually the first month since June that energy prices have risen month over month. Gasoline, first month since June that gas prices had increased month over month. And then you look at some of these other items, and there's some reason for optimism here. I mean, apparel went down, furniture and bedding down 1.2% for the month of October. Used cars and trucks down 2%. So used cars and trucks have only risen year over year by 2%. That's good news. Medical care services went down for the month of October. But then you have other things, motor vehicle maintenance and repair, that's high. Went up almost a percentage point in October, up more than 10% for the year. Motor vehicle insurance went up 2% for October, up 13% for the year. Airline fares, after several successive months of going down, are back up again, went up 3.5%, and are up 43% for the year. Shelter, up 7% for the year. So that's the takeaway. We'll see. It's all about how does the Fed respond from this point forward, and that will be a focus of future Inflation Nation videos of what's the Fed going to do. And I think that December meeting, the FOMC meeting, a lot is going to depend on the CPI read for November when we get those numbers in early December. The Fed won't raise rates by less than 50 basis points, but they may go for a fifth consecutive 75 basis point hike. Anyway, that's all I've got. See y'all later. Bye.